Welcome to the meeting. I'd like to thank Matt and InvestorQuant for their help in the facilities. We're going to have Matt Williamson talk on strategies and volatility strategies. And that'll be a guest speaker. He'll be remote. I'm going to talk right now on 60-40-20. Andrew Faldy has given a whole series of talks on his invention, which is 60-40-20 strategy. And it's been very popular here in the group. So we have a number of members trading it. And it's something of a focus in this group. It's a broken wing butterfly, and it falls in the general category of option income strategies. How many people here are already familiar with net zero 60-40-20? Okay, who here hasn't got the vaguest idea of what it is? Okay, there's always going to be some people who are newer who are going to be in that category. And so I'll give a very, very brief background here and review on that. We're going to talk about the latest enhancements made by Andrew Faldy to it, and also my own test results, which validate some of what he's done. They're independently. In other words, I haven't used his data or his code. I've used my code. And I think there's a very important message in what he's done that has to do with diversification. And we'll be getting into that. But first, let me talk about what the background is to it. It's a broken wing butterfly. It's an option income strategy. And here are some links on the slide. If you want to go back to the source, who's Andrew Faldy. Options Tribe is their webinar series at SMB, and what I suggest is that they have some absolutely excellent webinars, many of them by Andrew Faldy. They're free if you watch them live. Otherwise, $30 a month, including the archive. And now let's talk a little bit about 60-40-20. Very, very simply, it can be placed and entered 60 days before expiry. Now, all of these are not necessarily firm. You can change them around, vary them, and that's very much part of the experience of trading net zero 60-40-20. Personally, I just love the name 60-40-20. Andrew Faldy has mostly gone to net zero now, and the reason for the net zero is that it's a broken wing butterfly with NetZeroDelta. You keep it pretty close to delta. You can bias it in some circumstances. Many broken wing butterflies, let's say M3, you may bias them a negative delta as customarily, and there are changes. You can vary that too. But in general, as a starting point, before you make your own customizations for the market and so on, you would tend to make it at a zero delta, which it will automatically be if you can do the arithmetic, if you place two short legs at 40 delta and long legs at 60 and 20, because that 2 times 40 is 80 and 60 plus 20 is 80. So that will be zero delta. And it's basically a trade that you let run as long as possible. It's intended to be a no-touch trade, no adjustment, except you take it off when the short legs, delta, has changed by 20% or 30% or some other value that you choose. But originally he said 20%, and right now I like 30%. You can you can use your own number. When you do take it off, you don't sit and wait for 60 days before the end of the next month. You replace it immediately with another spread, approximately 60 days out. You can, there's different variations of that. You can use weeklies or whatever. And by the way, I like 30 days also, and so do other people. Other people have variations. And it's not sensitive to most of these parameters. In other words, they're not critical at all. Let's move on. This was one of Andrew's illustrations of what the risk graph looks like. Most of you will be very familiar with that. It just looks like a broken wing butterfly. For those of you who are not, it would be probably too time consuming to explain it, but if you look into broken wing butterflies in general, you'll see that these risk graphs are typical of option trading platforms that project the evolution of your profit as the market may move up or down and as time evolves. I'm not going to get into that today, and I'm also not going to get into in any depth, and I'm also not going to get into numeric results to an extreme degree at all. And by the way, I do have a couple of URLs there again that you can look at to give credit where it's due to Andrew Faldy, as I'm going to keep doing here in any case. Now, here is a simulation where I ran ES. This is on, you could run it on a number of underlyings, but in this case I ran it on the S&P 500 E-mini contract. 60 days before expiration, I'm entered. And in this case, I happen to use 50-30-10, which I like, instead of 60-40-20. Again, if you 2 times 30 is 60, 50 plus 10 is 60. So again, that is neutral. And in this case, this is just my labeling. I'm just explaining my labeling convention. And in this case, I'm using a 40% tolerance on the short leg, which is high compared to what Andrew might have recommended as 20 or 30%. But that's just coincidence. I just put this up as one example to show the history, the evolution, the cumulative profit. I happen to use this time period, 2011 to 2017. Am I anybody's way here? Hopefully not. And it's just the cumulative profit, or which you could call the value of the account as time evolves. Now, it's a little bit ragged there, as you will note. There are periods of losses. You see them in 2013, 2015, and you see a little loss just recently here too. But overall, it trends nicely upward. Does anyone have any observations on that? Does that agree with what people's experience would be? Fairly flat through most of, according to this in particular test, through most of 2017? Yes?
We had a question from the audience. So it's 30 delta times 40% equals plus and minus 12 delta range?
That's correct. Exactly correct. So if it goes, now if it goes outside that range, you know what happens. You take it off. You don't make any adjustments to the legs. You simply take it off and re-enter it. Further out probably, because if a little time has gone by, then you will no longer be 60 days to expiration. So you'll probably be entering it out further out and maybe a little bit less sensitive to the evolution of the market. An advantage may be too that you you're entering it at a better time because if volatility is high, it affects the prices. The value, your cost, well, yeah, your cost will be lower. The value will be lower. So you're buying more of something that's cheaper in that it's further out. Yes.
2017 was the year that the S&P advanced positively
Right.
for the entire year.
Yeah.
There's almost no growth, and you've got a flat return.
That's what mine showed. The I'm not sure that just advancing at it. What would be your experience, Mark, through 2017?
Well, I turned in a positive return in 2017. Could have been maybe the way I was managing.
Yeah, Mark was adding some additional management, but I would say it's not necessarily a contradiction because
That just implies to me that this is kind of like a road trip trade, which gets eaten up with a positive. When the market goes, you keep grinding away with a positive trend. Road trip trade.
it can provide, it can and it cannot. I mean, it just depends on where your legs are placed, how far out you are. And it could be, I'll try and look later. We'll try and look later at some other parameters and see where.
It appears that it's done very well in volatility. Early 2016 was very volatile. You see it's straight up there.
2016, that's true because
It did take a little bit of a drawdown during the China news in late summer of 2015, but as soon as that volatility picked up, it started to come down a bit higher.
yes, Brian.
What are you assuming for slippage and commissions?
I'm not assuming anything, simply because I like to do it that way, because if you assume something, it's debatable. I mean, nobody agrees with anybody else on how to do it, but if you put in a value, then it's impossible to recreate somebody else unless for their profit and loss. If you start adjusting for it, then, whereas this way you can simply take the number of trades, multiply it by your slippage, so-called slippage rate, and commissions, and adjust it yourself. But I do have those values also. In other words, I do have other calculations, detailed calculations that both include it and do not include it. Yes, we have another question.
Can you restate the questions first?
Thank you very much for that question was, what are you assuming for commissions and slippage? And I'm glad you reminded me. Please remind me if I forget. Yes.
What is your buying power that you're tying up in order to generate this profit?
What is the buying power?
Buying power, because if you have a growth multiplier, you're probably going to end up some of your buying power.
It's going to, he's asking how buying power would be affected. What is, I don't understand the just.
Maybe a margin. So you think, you're basically use margin for it.
You do need some margin for the trade. I mean, particularly centered, I think, on some people have said it may take more margin because the wings are wider than some other strategies. Mark? What is the margin situation?
Well, I trade a Reg T account, so it's just a max loss. It depends how big your trade is.
Yeah, they shouldn't be charging you any more than one side.
Right.
Yeah.
The question is, what was the size of that? Well, you got $2,000 there.
Oh, that. Yeah.
How much did you have tied up?
Yeah, I wasn't going to focus on that. I couldn't tell you right off because I want to focus on the subjective characteristics today. And then another time we'll go all into the exact numbers. I mainly want to focus here on the shape of the graph. Let's go. Now, and that's what I'm going to do right now. If you want to know an average, it doesn't really matter, because here's why it doesn't matter. He was asking me about the margin, because the best indication of the overall profitability of the trade is other people's experience. In other words, you can look at Andrew Faldy's experience, at some of his, or some of the other numbers that we have from our members. And those are going to be as good an estimate as any as to the profitability of the trade. And to just try and look at one example, which is only intended to be one particular parameter, really would not illuminate anything. Now, there's great benefits in general to diversification. As a matter of fact, it's essential in my point of view. Many people have not taken that point of view and instead believe in gaining expertise in one particular area, one particular trade, and you definitely hear that argument, that suggestion made, and there's nothing wrong with that at all. But if you want to scale up your capital and you're concerned about trying to make money as much as you reasonably can without increasing risk, then in my opinion, you want to move to a diversified strategy. And it allows, assuming you are profitable, it allows you to increase leverage and make more money. I actually did this with ES, with the E-mini, and I do all my trading with futures options. And so the margins are totally different anyway than they are for Regulation T. Regulation T takes a max risk basis for calculating margin, which is a ludicrous approach. And also, if you put on multiple strategies that help each other, half the time Regulation T fails to take account of that and instead charges you more for reducing your risk and diversifying. So I personally am a great advocate of trading futures options. However, there's nothing wrong with trading Regulation T either, but it's just from my personal point of view, the margin is purely risk-based. And there's downsides to that too. And we don't have time to get into everything, I think, but there's downsides to futures options, namely commission rates is something that people get very worked up about, particularly if they're with TD Ameritrade, because TDA is not favorable towards futures commissions. Their commissions on futures are not favorable. And to tell you the truth, IB is not really great either as a futures trading platform. They have their own problems they're not really oriented toward that either. But at least they have low commissions. And so now there's many ways we can diversify. We do for a moment assume the benefits of it. And including with time, you can have some trades placed close in, some placed further out with different Greek exposures, some exposed to maybe Vega and some not. And the diversification I want to talk about today, following Andrew Faldy, is to a different underlying. So let's look at crude oil. And Andrew Faldy has switched now in his trading to trading a mixture of, yes, still some stock index underlyings, but also the largest part of his trading now he's doing on crude oil futures options. And the reason he's done that is that he experienced better overall results, both in consistency and in profits, and trading with crude oil. He has a hypothesis that there's something wrong with the pricing of, and I'm misquoting him here, but with the pricing of ES, there's just so many, and S&P 500 options in general, there's just so many people, as we all saw recently, selling it, that he doesn't think it's the wisest thing in the world to base everything on selling it because he thinks that there's biases built in. People have an assumption that there's like a Bernanke put, that the governments have a safety protection net under the market. And so he's concerned that those prices are not as market driven as he finds in crude oil. And now he found that futures options are extremely liquid overall, extending over many years. He said he gets better fills, or just as good fills, let's put it that way, with the futures in CL than he does with the stock index options. If you look at it, you'll find that it's correlated in the very, very short term with the S&P 500, but it is subject to different influences overall, and is an excellent diversification overall to trading in stock indexes. Okay, he uses exactly the same rules for trading 60-40-20 as he does for S&P. In other words, it's still an entry with legs at 40 delta, 60 delta, and 20 delta, roughly speaking, subject to variations that he changes all the time. I just went back to 60-40-20 as opposed to the finely calculated variations, just because it's an easy thing to remember. But it may really be 58, 30, whatever, at any given time. Well, okay, so here are the results trading crude oil and options. Now, in my simulations, they should be accurate. I'm using a 40% tolerance here, and 50, 30, 10, again 60. If you'll notice, this is a much smoother line than it was. Could we go back and find the other one for a second, Matt? Yeah, see, this is a much more jagged line. So, and then back again, please. Forward again, please. So that's a benefit right there. And the diversification it brings is also a benefit. And when I do these simulations, I'm doing them with closing price, daily prices, right off the exchange. And I believe they're very accurate quotes. And obviously, there are differences in methodology. The way I price profit, daily profit, and this is done on a daily basis, is I add together all legs and base it purely on the market. I never look at anything like close. Some of the statistics you see from certain people are based on when a trade is closed. Only then, they only count realized profit and things like that, which are totally wrong. The correct way, because whether your profit is on paper or real or has been realized, it should be included because that's the liquidation value. You should use liquidation value. And now, okay, so that is. Does anyone have any questions on that other than the exact numbers? Yes, Matt.
Is the net profit for the last 5 years only $200?
No, those are not dollar numbers. Those are in the units of the underlying. I am not.
$1,000 a point in CL?
It would be, yeah. So it's better profit. You can take it this way. I just don't even look at the numbers because, except at a separate stage, because we know that Andrew Foldy has found that it is considerably more profit. I would like to go into the numbers in detail another time. In this meeting, I'm just going to focus mainly on the drawdowns. Yes. I exit at, in this case, with a 60. The question was, when do I exit on in terms of days? I exit at 30 days and enter the other one if we haven't already exited. And if you want to do discuss a fuller regime of the details of the strategy, you should also have stop loss strategies and probably target profit strategy as well. although I wouldn't take it too early because Faldi's strategy approach is to let it run. Okay.
So is this the 60, 40, 20, or is this the 50, 30, 10?
That one, I'm sorry, yeah, was 50, 30, 10. Do I have them both? That particular one is 50, 30, 10. It's somewhat crazy to generically call it all 60, 40, 20 and then vary it to 50, 30, 10. But I also have the 60, 40, 20 numbers. This was just happened. I just grabbed a particular example that happens. The reason I'm doing both is in the simulation is to see which is better. So I do both in every case. Okay. Now, now comes the interesting part. Already, we've established that we can that maybe crude oil is a better, or at least as good, a trade for you to trade 60, 40, 20. Certainly a great diversification. Hopefully, less drawdown and more profit. That's Andrew Faldi's result, which he gave some more details of, and I have also elsewhere. So let's diversify further, and this is a really exciting part that I particularly motivated me to want to share Andrew Faldi's ideas with this group, because some people said to me they hadn't seen his talk, and that's to let's diversify further by adding a trend following strategy. And I'm not going to give all the numeric examples, but we'll look a little bit at it. And one obvious, in general, the strategy that 60, 40, 20 or broken wing butterfly succeeds when the market stays in a range. Well, a trend following strategy in general is going to profit when it breaks out of a range and keeps going. And they complement each other very nicely. And so this applies in certain cases and not in others, which I will show you. And I just love the idea of finally getting back into having a trend following strategy, because that was certainly my objective all along. You don't want to be stuck in only selling volatility, because it's too much of a position, that taking a position that's not really justified. And also, you can make more money when you do have big moves in the market with a trend following system. I mean, obviously, you'd be losing on your volatility selling strategy, but beyond that, you simply can make more money if you have every now and then, like once every 2 years, 3 years. Let's say crude makes a huge move, you have the potential for windfall profits if you have diversified into a trend following strategy. And since we're mixing it with a volatility selling strategy, we can do it more aggressively and less painfully than if it were done alone. If it were done alone, the drawdowns could be too much of a tax and deter people from maintaining a position, which, I think most of us are in that position. We've maybe traded trend following strategies and then lost money for 3 years or something, waiting for the big move to come. And then when it finally came, we'd given up on it by then, on putting up with the small losses. And Matt, did you, well, let me ask Matt a little bit later about this, but yeah, okay. Okay, okay, so here are some rules. Now, Andrew Faldi said, let's use a really simple trend following strategy. And he actually found that it doesn't really matter that much what trend following strategy you use, to a degree. I'm sure there are refinements, and We have some people here, including Matt, who are probably experts in trend following strategies, but at least for purposes of illustration, let's take a simple one. And this is the one which I never would have thought he would come up with one that would be this simple, but he did, and it works well for him. And so his strategy is to start with, use a future, and I'm giving a copy of these slides, of course, so nobody need to take notes, but simply stay in the market all the time, long or short, but the future is the easiest way. And reverse to short or enter to short on a new 15-day low, and reverse to long or enter to long on a new 15-day high. In other words, we're buying high and selling low, which is can work as long as it continues in that direction. This is called a donkey and price channel. And Matt, are you familiar with that? Yeah. Matt being a future trader and other people are familiar with that. Do you ever use it? It's too simple, too simple-minded. Okay. Okay. And you can also use other indicators, and Andrew Foldy does. One other he mentioned is the slope of the moving average. And I'm sure Matt would be able, obviously, after a while, you would come up with a tailored one. But Andrew Foldy really likes simple in both his credit spreads and in his moving average systems, I guess. Okay. So there's a variant on it that he uses also, and I'm going to show you also. And that's, instead of using a future, using an option spread. And in other words, enter a credit spread instead of buying or selling a future. This adds a little bit of decay, theta decay to your profit, and can make you more profitable. And I'm sure there must be some downsides to it as well, but it's a little more risky, I guess. I'm not sure it's unreasonably risky, though. So again, now these tests are mine. He uses completely different values, but I used a 50-30 spread, and following Andrew's example from his 60-40-20, I adjusted after a while if that loses power by decaying too much or by getting too far away from those delta values. So I'm making it a static or keeping the deltas in range. So let's do it for crude oil. And Andrew got these results, and I got similar results. I mean, these are my results, my testing, my code. But he got charts that look like this. And I didn't know when I went to test it whether, it was really going to be that good. But it apparently is. Well, it is. And as you can see, the blue line is defining the trend with options, and that gives you a higher profit than the green line, which is, again, don't go by the numbers. I'm just looking at the relative performance, and so it's even better with the options. And you might want to put on some additional protection with the options. It's debatable. Yes, Ryan. Say that again, sir. What I do is I sell a put spread if I think the market is going up, which means it's broken the high end of the channel, and he sells a a call spread if at the other side of the trade, which is what he said and what I programmed, and it seems to give similar results. So, I mean, this is very exciting because it opens the potential for profitable range trading. I'm sorry, not range trading, trend following trading. Okay.
Hey, Don, is this the combined results? In other words, does it include the trend following alone, or is it trend following with the?
No, those are not combined.
Just the trend following alone.
I'm not, not in that chart. He has charts that do combine them, and I'm not going to go to that level of detail today, but they show a very nice improved result on reduced margin and with better profits.
What we're looking at is the trend following system just as itself.
Say again, Ryan.
These charts are just the trend system.
This is just a trend system now we're looking at. We're not mixing in the neutral, but you should. In other words, you should test and you'll see, and we'll maybe have time another time to show the combination of the two, where you can look at some of Andrew Foldy's results, which do show, a very clearly a real improvement by combining the two. I mean, you can easily see it too by if you look at the periods, and he goes through some of this in some of his talks, his recent talk, where you can see where one is suffering badly and the other is gaining. And so that's an example of, he has a number of examples. If you look at historical incidents where S&P had a big fall. Now, typically it'll drag down crude a little bit too, but not to the same extent. And he also finds that the crude pricing is more rational on the options when there is a big move. It doesn't go to the extremes, the volatility extremes that the stock index futures do. Okay. So, okay. Well, that is about the basic point I wanted to make, which is that, well, let me read these since they're here. And if you're designing your trades, I mean, that basically covers what I wanted to say about the Andrew Foldy's recommended trade. Does anyone have any comments or questions? Yes, Arthur.
Yeah. Just two thoughts. The one, I think two graphs.
Let me go back to the mic here. Arthur is saying we need a lot more charts showing the correlation of these comparisons of the different strategies to moves of the underlying. I agree, absolutely. We need to do that. Andrew Foldy has done that in some of his. And I didn't want to make this an omnibus presentation here today, just because I didn't have the time, and I wouldn't have the time to present it anyway. But I think we definitely need to really finally analyze exactly what all of these, for all strategies, when do they work for a given category of market move, and when do they not? And there's a lot that can be said on that. Even of the existing strategies. Sorry, you had...
I was just going to say...
Yeah, the gentleman is making the point that the trend is relative. In this particular case, using a 50-day look-back period on this, and that's, I put that simply because Andrew found that best meshed with the kind of periodicity that he had on his income trades. And so he was roughly trying to match them to each other. What you need to do is, is do that. Try and get them so that they overlay the two and match them one on another. Any other comments or questions? Do people basically understand what has been suggested here? Are there any comments, any questions remotely, Matt? Oh, I'm sorry. Michael has a question.
Why does this?
You see, that is a key question. Basically, we're saying here that that really this is a lousy idea to trade a trend fall. I guess that was your point too. To trade, he says, why does this graph go down while the other one went up? And that's a whole point that I almost forgot to make. Namely that that the stock index is not a good market for doing trend following. For trend following, you want to market the trends a lot. And it turns out, and it's quite a strong statement, isn't it, that it appears that crude does trend. And that's why to get the benefit of a trend following system, you have to switch. You have to do it in crude. You can't do it in ES because ES is proving itself here to be a lousy market for a trend following system. Okay, there may be, if you found the right periodicity, the right can you tell us? Is it Hoyt? No. Okay. Mm-hmm. Yeah, I mean, I wouldn't give up all hope. There may be. Matt may know. Are there some trend following? 5,200 crossover of the moving averages. Yeah. Are there any good trend following systems for the?
I'm not a trend follower, but 15 days just does not seem right.
The market is just bouncing back and forth like crazy, and that's.
And if you're an inside trader and you're using volume or you're using tip or you're using time charts,
Yeah.
that's fine. And I got a lot of friends of mine that make a lot of money on
Yeah.
it.
Yeah, but that's swing trading. That's swing trading.
That's not.
Okay. Oh.
The 10-minute chart. You're trading during the day, like at 10 o'clock. You're going down to 3 minutes. You got to follow it. You just got to find your way to get followed.
Okay. So yeah, that's the whole point that with these parameters, other parameters is another story, but with these parameters, with this system, and Andrew's experimenting with about a whole bunch of different indicators, and this seems to be. He speaks also. He uses the term an edge test. In other words, this isn't exactly it, but he likes to use a very, very simple test to test if there is an edge there. There are also implications here for, I'm listening to myself through the feedback through something. There are also implications here for a number of areas. Like, obviously, you wouldn't want to stop at crude oil. There's a number of other markets that the goal would be to combine crude and getting my own. There are a lot of commodity markets that may trend very nicely, and ideally you would diversify across a whole bunch of them. And that's precisely what I want to do. And you would have both trend following systems and systems that were betting on reduced volatility.
How many days to expiration did you assume for the credit spreads in your trend following example?
And days to expiration. I was just rolling it over whenever the delta got out of line. let me see. I think I was putting it as close, reasonably close in. It would be 5 or 10 or 15 days, because the closer in you come, of course, the more responsive you are to, in terms of your profitability, the higher your gamma, I guess. And other questions or comments? Arthur? On this one? Oh, the green one. Yeah, exactly. That's why well, okay, let me first of all repeat Arthur's point here, which is that if you look at the crude oil trend following chart, you'll see that there's a whole series of years where you have no profit at all, and you're probably doing worse than that if you add in the commissions. So that's why, but look at the advantage of adding in the option to that, even on the trend. I mean, that might be somewhat questionable, because you might say, heck, I'm going to sell volatility over in my other companion system, and I'll keep this one pure trend and absorb the cost. They're probably equivalent to do it either way. It just depends on the amount of capital you allocate to each one. Well, Arthur is saying, were there things in the market going on in that time period? It's certainly possible. And I think for any system, you eventually want to look at that chart and, as you say, plot also on the same chart, the underlying, and maybe match up some events as well, and go through what happened in Brexit, what happened in the flash crash, what happened in all the different, in the case of crude, we could have certain geopolitical events. But the lesson here was just that crude is a great market to diversify into a trend following system. Stocks are not. If you want to stick to stock indexes, or at least not with the system we came up with here, if you want to try diversifying into a trend following system, you better find another system, and you better not use stocks. You just can't have that benefit. And you can have it with crude. So it's just another plus for crude. And so is Matt online yet? Okay. And we'll wait for him. Let me, I'm noise. I apologize for that. In this case, it's looking at drawdown. And I'm wondering, can you see? Okay, well, I don't know why. Yeah, drawdown. I've looked at a number of different stops of different ways. An interesting question is, we have the method of exiting our trade with 60-40-20 when our delta gets out of range. Well, another different approach, instead of doing that, an approach we might take is, let's first of all not take any exit at all. Would our profits be higher? Most probably our drawdown is going to be higher, but would our profit be higher? And just so we could know. Or are we better to stick with using the delta method? And the delta method turns out to be superior. If you look here, we had this particular spreadsheet shows drawdowns, the DD, and the S10 is with a 10% stop, and the S20 is with 20%, and so on and so forth. If you look over the DD with the Ds instead of the S's, it's much lower profits, but on the various strategies, but hardly any loss, hardly any drawdowns, much smaller drawdowns also. So really we'd have to go, hi Matt, we're going to give it to you in a second. I see you're online. So anyway, I just have these vast matrices of test results because you could run as many as you want, different simulations. And overall, I was tempted at first by some of the stop methods, but I ended up going with, which have S's there, I ended up going with indeed seeing the benefits of using the exiting based on stop variation. Well, I'm not going to go into detail now. Maybe we'll do it another time. We're out of time for my part. And let's see if we can establish communication with Matt Williamson, who is our speaker for the second part. Matt, can you see if you can we shift? Yeah. Oh, there we go. There we go.
Can you guys hear me up?
Yeah.
Hello.
Yeah, we can, Matt. That's great. It's a booming voice. We actually got to turn down the mic a little bit here.
Oh, boy.
Before we continue, before we create feedback here. But it's a great voice, and we see your slides too. Now, let me introduce you very briefly. He's Matt Williamson, has his own strategy company, Tactical Spreads. He's developed Fruit Fly was one of his systems that he developed. He's also developed more recently a number of volatility products or trades. He's trading, he's offered some alert services. He sells his strategies through his site, which is tacticalspreads.com. He has an excellent Slack group that anybody can join. Look at our announcement and you can see how to join it. Oh, this mic is so let's have for Matt Williamson.
Thanks, Matt. Oh, there's applause. I forget this is a live audience. So used to doing these things online. Yeah, so thanks for having me, guys. It's good to be here. I don't know if anyone's caught the futures. I guess Trump announced more tariffs, so down we go. So I suppose it's a good time as any to talk about vol. So my plan for this evening was to talk about vol. So let me get into the presentation mode here. Okay, let's go back to beginning of the series. Okay. Everyone can see the selling vol on a zombie apocalypse screen? Yes? Take your resounding silence as an affirmative. If you can't see that, please let me know, and I will amend that. Okay, so I originally did this presentation on the SMB Options Tribe a few weeks ago. I'm going to maybe sort of talk about a few different things today, but a lot of it will be sort of similar material. So before I get into anything else, I just have to do some disclaimers. So neither Tactical Spreads nor Williamson Asset Management LLC is a broker-dealer. Williamson Asset Management is the asset management company I own and operate. It is a registered investment advisory service or a registered investment advisor, but it's not a broker-dealer. Tactical Spreads, as Matt mentioned, engages in trader education and training. The seminar is for educational purposes only. None of the information presented herein should be construed as an offer or solicitation as an offer to buy or sell securities. It's for educational purposes only, et cetera, et cetera. So please read through the slides and disclaimers that my compliance team insists that I put on these things. So make sure you're aware of all this. And all right, so we'll dive in. So a bit about me. I've been trading for about 7 years. I tend to do delta neutral strategies. I'm not a big directional trader. I tend to not be very good at it, but occasionally I do dabble in directional stuff, but I try to give myself tons of margin of error. So I will take a long position with positive theta just kind of give myself a stop on both ends. But I tend to trade delta neutral short vol. As Matt mentioned, I've designed a handful of strategies for small, large accounts. Some of them are PM strategies, some are Reg T strategies. You can find all that info on tacticalspreads.com. And I make my living trading, teaching, and mentoring option students. And as I mentioned briefly, I do own and operate an asset management firm focused on options and arbitrage trading. So that's just a little bit about me. All right, so why another webinar on vol? Volatility is the most important part of options trading and being profitable as an options trader unless you're trading directionally. If you're trading directionally, you can just buy your delta and gamma and do just fine as long as you get the direction right. But if you're like me and stink at direction, then you've got to have a pretty good handle on vol and what it is and what you're doing with it. So it tends to be the most poorly understood part of options trading. So I'm going to try and break down some of the misconceptions on when we talk about vol and what that means. And if you don't understand vol, it absolutely can and will wipe out your trading account. So you really got to know. You got to know what vol is and how it can hurt you and how it can help you. So hopefully we'll do some of that tonight. All right. So what is vol? There are two types of volatility. There is what we call historic volatility, which is also known as realized volatility. That is what already happened, right? So depending on which method you use, it's basically a trailing calculation on how volatile whatever the underlying is you're trading is. So that is the vol that has already happened, and then there's implied volatility, which is forward-looking, which is called, which is abbreviated IV, and that is what we'll be talking about for the rest of the presentation. So historical volatility, again, backward-looking and implied vol is forward-looking, and everything we'll be talking about from here on out is implied vol. All right, so in layman's terms, implied volatility is how likely you are to get, or the likelihood of how volatile the future movement in the underlying is. And it is found in the extrinsic value portion of the option. So I'm sure we all know this, but an option value has intrinsic value and extrinsic value. So everything that is not intrinsic in the option price is the implied volatility. So to put it another way, so if your implied volatility was 0, that would mean that the option price was, or the option was pricing in no movement in the underlying. So if you had no extrinsic value, that basically means that the option market is pricing in absolutely no movement in the underlying. Matt, I'm getting a bit of an echo just in the last couple seconds or so. That is better. But let me know if you have a question. I don't know if there's a, let me go back to the presentation window. I don't know if I can see questions or anything coming in. Don't see that ability. Hang on just a second. I don't want to create dead space in the recording here, but okay.
So you're pausing.
Yeah, I just want to make sure. I was trying to find if there was a chat or anything I should be keeping an eye on. I don't see any controls or anything, so I'm assuming there's not. Okay, so I'll continue. So if implied volatility was 0, that means the option market is pricing in no future movement. All right, and the only time that really happens is at expiration. Just a quick example. So let's say we got the old ABC underlying trading at $100, and your at the money straddle, which is the long call and long put, or short call, short put, is priced at $5. And you have another underlying XYZ is trading at the same underlying price of $100, and the at the money straddle is priced at $8. So in this case, XYZ is pricing in a much more volatile move because the option price is $8 rather than $5. So XYZ would have a higher implied vol than ABC in this case. If you looked at the two numbers, XYZ is carrying a higher implied vol. Right. Despite both underlyings having kind of a 50-50 coin flip chance of moving higher or lower, because the option prices in XYZ are higher, they're at the money, they're pricing in more movement, so the implied vol there is higher. All right, so one more example here, and this is kind of we won't go into a rabbit hole on skew, but this is kind of just a quick thing on how skew works. So that same underlying, so XYZ here, at the money straddle is priced at $8. that means the at-the-money put is roughly $4 and the at-the-money call is roughly $4. If you look down the chain, 10, 20%, we find that we have an out-of-the-money put priced at $1. Right, so the at-the-money put is implying a $96 expiration, right? There's a $4, we have a $4 put there, so it's pricing in sort of a 50-50, $96 expiration. But if we look at that 20% out of the money option that's priced at $1, it's implying that there's a possibility of the stock closing at 80%, which is a much, much bigger move than that $4 move the at-the-money option is pricing in. So that the out-of-the-money option is carrying much, much higher implied vol than the at-the-money option. So the at-the-money option is pricing in a $4 move. The out-of-the-money option is pricing in a $20 move. So that out-of-the-money option vol is much higher than the at-the-money option. And generally speaking, the at-the-money vol will be lower and the out-of-the-money vol will be higher. It's not always the case, but generally speaking, yeah. And again, that could lead us into a conversation about skews and smiles and smirks. When you hear people talk about vol smile and vol smirk, they're talking about the shape of the volatility curve, which we're not going to really go into here. It's just too much of a rabbit hole for now. So, okay, so that brings us to the next topic. What is Vega? So Vega is the sort of the Greek measurement, the risk measurement associated with your vol. So if you have any options position on, you're going to have some Vega measurement. The textbook version that they usually give you is that Vega is the measurement of an option sensitivity to changes in the volatility of the underlying asset. And that number, the Vega number, represents the amount of P&L basically that your option will experience with a 1% change in the implied vol of the underlying. So the more kind of layman's version here is that Vega represents the effect of supply and demand on your position. So if we think about kind of basic economics for a second, if your underlying instrument, so let's say we're trading Apple for a moment, if all of a sudden there's a huge demand for Apple options, the option prices are going to go up, right? Because everyone wants them. The demand pushes price up. So when those option prices get pushed up due to demand, if you're holding long options, that's great. You're going to have a positive P&L. You're going to make some money off of the increase in demand. And the way that's represented is that your Vega number will be positive. So if you're holding long options in anything, you're going to have positive Vega. And if the demand increases, meaning all the option prices get pushed up, then you're going to make money with your positive Vega. That's kind of how it works. So conventionally, what you'll usually see is if your Vega reading is, say plus 100, and implied vol goes up by 1 point, you'll make $1 or $100 because your implied vol went up. But really, what happens is your Vega reading was 100, and then the option price is caught a bit somewhere in the chain, which means that demand came in, driving up the prices for all the options enough to imply a future volatility level 1 point higher. Right? So all the option prices just went up, implying more movement in the future, or implying more volatility. And since you're holding net long options, you benefited to the tune of $100 in this case. So because you had positive Vega, but more directly because you're holding long options that are now just more expensive because because demand went up. So it's all about a supply and demand kind of shift, basically. If the opposite happened, and all of a sudden everyone wanted to dump their options, well, the prices are going to go down, right? And if you're holding long options and everybody wants to sell long options, all of a sudden your long options that you're holding are now going to be worth less because everyone wants to sell them. So it's kind of more of a supply and demand reading on your position. So if you're holding long Vega, then you are, basically sort of long demand, if you want to think of it that way. You want demand for those options to increase. Okay, so just one more example to kind of drive the point home. This is kind of a non-options example that may be, more relatable. So let's say I own a hardware store in some wonderful beach community in Hawaii, right? And let's also assume that I'm really just a dubious guy. I'm really not a good guy. I'm a thieving, really bad character here. So one of my customers comes in and buys 30 boxes of nails. All right. Now usually I wouldn't sell 30 boxes of nails, so my eyebrows go up. I say, that's a little weird. This guy's buying 30 boxes of nails. So I turn on the news to find out if I missed anything. And on the news, there's news of a hurricane coming. So I say, okay, this guy bought 30 boxes of nails. He wants to go nail his boards up and get his house ready for a hurricane. I better jack up the price of all the nails because I know I'm going to be able to sell them because everybody's going to want nails. So that's basically what happens, right? Someone comes in, buys a bunch of options. market makers say, okay, there's demand now, let me push up the prices for everything else, because if this guy wants some, clearly everybody else is going to want some too. So that's sort of a, very basic version of how the supply and demand shifts. Okay. So that begs the question, is Vega even really predictive? If you see that you have 100 Vega, are you actually going to make $100 if implied volatility goes up a point? Well, kind of, and sometimes. All the strikes don't go up by even amounts, and if the overall average implied volatility goes up 1%, some strikes may have gone up 3%, some strikes may have gone up 0.25%. So we can't really use it as a hard and fast measure, but you can just use it to know whether or not overall you are sort of long supply or long demand on your options. So that's maybe kind of a better way to look at it. And Matt and Don, forgive me, I don't know exactly what the sort of makeup of the audience is, so I hope I'm not talking under or over everyone's head here. I hope I'm kind of talking to the middle, as it were. But please jump in and tell me if I'm way off base in terms of where everyone is in terms of their education and stuff.
Well,
that was kind of,
let me ask people, if I may.
Yes, sure.
We've got like 30 people in the room here, besides those online as well. Are people following okay? Do you have any questions? Are people, people say it's good. It's good.
Okay. All right, great. Terrific. Okay, so a quick audience participation question. What is the one implied volatility change that is always predictable? I'll let anybody take a stab at it that wants to.
Any volunteers here for answer? Yes, go ahead. It goes down as you get near expiration, the person says.
Not necessarily. The price goes down, but the implied volatility might not go down. In fact, it.
Any other guesses here?
It's a good guess. The price does go down.
Price goes down, volatility goes up.
Yeah, it's a little weird. If you think about it, if you have 1 day to expiration, for example, and you have 10 cents in time premium and an option that's 30% out of the money, even though you only have 10 cents left of juice in the option, that's implying that there's some chance that the stock might move 30% in the next 2 days, which is crazy high implied vol. Any other takers?
So all the answers are wrong so far. Anybody have another one? Okay, say again. Reversion to the mean.
That's a pretty good answer. It does usually revert to the mean at some point. That's a pretty solid answer. But you can't bank on it though. It's not always predictable. I'd say the one that I'll go ahead and give the answer. So the one change that is always predictable is that at expiration it's always 0. Yeah, the one thing that will always happen is that all the time value will go away when the option expires. There's a quote, I forget who said it, but it's something like, I'm going to mangle it. It's something like, oh God, I don't even know. I think I can paraphrase it. It's basically, it says that the one thing you can bank on is that options will always expire. It was like death, taxes, and option expiration. But I'll have to find a quote. It was not that at all. It's much more. It was much more eloquent. So the one thing that will always happen is that at expiration, implied vol will always be 0 because there's no more future volatility in the option contract because the contract's done, right? The contract has expired. Okay, so how to actually use Vega. One thing you can do, this is a little tedious, but it is kind of a useful way to use your Vega numbers. So what you can do is track your position Vega on a day-by-day basis and track your P&L on a day-by-day basis, and basically try to take out the delta and theta from your daily P&L, and what you have left over is roughly what you realized in terms of vol. So for example, if you have, just to use an easy example, if you have an underlying that doesn't move from one day to the next day, then your P&L as a result of delta will be 0, right? There was no movement. Your P&L as a result of gamma will be 0 for the same reason, there's no movement. Your P&L as a result of theta, if your position was profitable, you can take the theta number out, and then whatever's left over is your vol. So you can sort of track it along that way. Again, it's a total pain in the butt. There's no to my knowledge, there's no currently available sort of retail trading software that will give you a deconstructed P&L. I know there's some beta stuff that I've looked at, but there's nothing sort of widely available that will give you a, your P&L came from, this much of it came from Delta, this much of it came from volatility. But if you do want to track it, that's kind of one way you can do it. And then compare it to, what it should have been. So if you're trading like an SPX structure, you can look at what the VIX did, and if the VIX went up a point and you were holding 100 Vega and you made $80, you'll know that, okay, well, my Vega's, understating my P&L by X%. So it's just one way to use it. It's not something I do a lot. It's just an idea to throw out there. Okay, so basically everything we've talked about so far is that option prices pretty much are just derived from supply and demand. If we throw out everything we know, we can just say that, hey, all the prices ultimately come from supply and demand. All the numbers and stuff are just sort of mathematical representations of supply and demand. So now the next part of the presentation here, we're going to go over some human behavior regarding supply and demand, and then after that we'll talk about some practical ways to use the kind of stuff we're talking about. So I'm going to put us in a zombie apocalypse scenario here and talk about human behavior in a zombie apocalypse. So we actually recently had the misfortune or fortune, depending on which side of the vol trade you're on, of going through the market equivalent of a zombie apocalypse, right? If you were trading in early February and you were long vol, I mean, you just had a fantastic month, right? If you were short vol, you probably had a horrible month. And it was, it was pretty crazy. The fear was very, very high. Volatility basically just completely exploded early February. So we just went through it. So hopefully this will be fresh in everyone's mind, for better or for worse. All right, so let's lay out some scenarios. So our scenario number one here, we have some possible zombie activity going on. It's too early to tell, but there's definitely a little something happening. Some guy in Florida was eating another guy's face in the middle of the freeway, which, by the way, actually happened. I don't know if you guys remember that. It was like 5-6 years ago, maybe. There was a guy just eating another guy's face in the middle of the highway. I believe it was attributed to bath salts. All right, so we've got some possible zombie activity. And what happens is we've got a little bit of heightened fear, right? Like the very conservative, cautious folks are out buying some guns just in case something happens. So the market translation here is that basically we've got a little bit of a dip in the S&P, maybe a 2% correction or so after a period of just nothing but bullish behavior. So in other words, very end of January, first couple of days of February, right? Market sold off a little bit. Most people just say, well, market fluctuates, we'll keep going back up pretty soon. Some people might consider buying some puts. Again, the really conservative people just bought their puts, right? They said, all right, maybe it's over. I'm going to go ahead and hedge just in case. But everybody else just doesn't hedge, does a quick check on fundamentals maybe, and says, all right, everything's fine. All right, and then a week later, zombie situation getting worse. We got some deaths, some weird sounds. You got Aunt Marlene not answering her phone. Some things are deteriorating. And what happens now is that the shotguns and ammo in our scenario here start becoming, there's more demand for that. They start becoming in high supply. So the stores are starting to price gouge a bit, right? And then the other weapons that are not shotguns start selling also. So puts, volatility products, everything's starting to get bid up a little bit. Right now we're off. We're breaking 20-day moving averages. We're breaking 50-day moving averages. Things are starting to deteriorate. We haven't hit the uncle point yet, but things are definitely starting to get a little worse. Our poor Jane here is contemplating buying some puts, but now they're pretty expensive, right? The stores have realized that people want these shotguns, and now they're starting to jack the prices up. So the savvy retail traders are now out buying puts. The smart people are out buying their shotguns despite the fact that they're being bid up, basically, despite the fact they're more expensive. The people know they need to start hedging. They're going to start buying them. All right, okay, fast forward a week later, your town is now ground zero for the official zombie apocalypse. Everything is crazy, panic, just total mass hysteria, right? At this point, shotguns and ammos are now selling for, hundreds of thousands of dollars. It's just any weapon you can get your hands on is selling for an astronomical rate. Any kind of protection you can buy is exorbitantly expensive. because it's either that or get eaten by a zombie, right? So if you're desperate, you're going to shell out thousands of dollars for an old rusty revolver because at least it's a gun, right? At least you've got some protection against the zombies killing you. So at this point in our market, fear has now peaked. It's, I think, February 7th, February 6th, whatever that Tuesday morning, Monday afternoon, yeah, February 5th and 6th. VIX is at 50. XIV has just gotten destroyed. It is now going under. I mean, just who knows what's going to happen. Puts are now trading for just absolutely insane, ridiculous prices. And people are buying them because what else are they going to do, right? If the market continues down lower, they've got to have a put. So anybody that waited is now willing to pay just completely insane prices. I remember when I was trading through this, I had a put that I bought. So I do a hedge that's basically constantly buying very, very cheap puts, nickel puts, dime puts. I had puts that I bought for a dime that I sold that day for $27, I think. I mean, just completely insane. These were worthless puts. This was a put that was like 600 points under the money that expired 4 days. I mean, there's absolutely no chance in the world SPX was going to get to that level. And people were paying $24 for it. It was completely nuts. But this is what people do. They have to buy puts, and they will buy whatever they can. They have to buy the cheapest put they can, and the cheapest put they can expires in a week, and it's still astronomically expensive. So all the takeaways so far is when that short-term panic hits, people want puts, and they want them now. That's all they want. They just want puts, and they have to buy them. They don't care what they cost. They will spend just completely insane price to buy those puts. And what tends to happen is the demand gets focused in the front expirations. So if you look, do I have a vol curve? I don't have a vol curve. Let me pull up a vol curve real quick. Just a second. If you don't already look at VIX Central, at least frequently, you should. So this is the volatility curve. So this is basically, you can think of this as demand for puts across the various, across time here. So this is front month. This is going into the back month. So just a few minutes ago, or maybe half an hour ago, Trump announced more tariffs. So as we were just talking about, let's see if I can pull up yesterday's close now.
Matt,
yeah.
could I ask you something?
Yeah, go ahead.
A couple of people thought the sound is chopped up a little bit. Could you, is there any other way you can do the sound?
Let's see.
Some people are having trouble following.
Okay. Is it my choppy speaking, or is it the sound actually choppy?
It's sort of sliced up, digitized.
Okay. I don't have another mic. My webcam has a mic on it. I could try that mic. Let's try that. Let's see if that does any.
Are you using?
Say it again. Am I using? I didn't quite get the end of that sentence. Now I'm losing your audio, Matt. Let me see if I can switch to a different audio feed. Estimated audio quality. I may have to find the option, so bear with me for just a moment. Let's see. I don't see an option for changing the audio. Matt is asking if anyone can hear me. Matt is asking if anyone else having audio issues. Yes, his voice is clipped. Can't hear Matt at all. And Matt, other Matt, I lost your audio entirely. Bandwidth issue, Craig is suggesting.
Can you hear us now, Matt?
I can hear you. Yes.
Okay. Yeah, we were at some sort of bandwidth.
Okay, you're clipping again. I just lost you.
Here. We're here.
Okay. Can everyone else hear me okay now?
It's a little chopped up, but.
Okay. Yeah, I don't see a way to I don't see a way to change microphones, so I'm assuming, and I don't ever have any trouble with the microphone. I'm assuming it must be some kind of network issue.
Yeah, that's my guess as well. I don't think we're going to be able to get it fixed. So just keep going, and we'll deal with it as we have to.
Okay.
Thank you.
Sure. So again, we just had the tariff announcement, and generally fear has been high anyway. So what you see is demand for puts in the front part of this volatility curve. So in other words, the front month expiration puts are being bid up harder and faster than the back month puts. And this is congruent with what we have seen historically through pretty much any kind of fear-based volatility event. People want puts and they want cheap puts, and the cheaper puts are in the front month. So demand tends to get focused in the front part of the volatility curve. So this stuff gets expensive. This stuff gets bid up also, but on a volatility basis, this stuff gets bid up way harder. So, so demand basically explodes in the front month. And actually, let me go back to VIX Central for just a minute. And I'm just going to pull up the historical curve for earlier this year, just so we can kind of take a close look at it for a minute. Okay, so January 29th, this is what a normal volatility curve looks like in contango. So demand for front month is less than demand for long month because we don't know what we don't know out here. We kind of know more or less what's going to happen in the front month, but we don't know what's going to happen back here. So the unknown factor is priced higher than the front month. So what happens though as this event kind of unfolds here, you'll see the front part of the curve start picking up. And then we go into backwardation where the front month is actually pricier than the second month. And then as things really get rough, you get this just crazy looking curve here, which is totally nuts. All right, and then it comes down some the next day. So anytime you get a big fear move, demand tends to get focused right in these front 3 months or so. So if you're holding long puts, ideally you're holding them in the front 3 months, relative to the rest of your portfolio. So, all right. So at this point, two things can unfold once the panic really comes in. It can either subside, so your town fights off the zombie horde here in this case, or it can kind of infect the rest of the market, and the whole market can sort of turn into like a bear market. Which the zombies would be devouring the town in our scenario here. All right, so if the first thing happens, the put premium that just got blown up will just deflate. Contango will take back over, and it's sort of back to the bull market. And if you were holding long puts that got really expensive and didn't sell them, you're going to be kicking yourself in the butt because they're going to go from $27 back down to $9. Just a heartbeat. Now it happens just so fast. If the contagion spreads and we go to like a sort of a bear market, then the rest of the vol curve tends to rise and everything just sort of gets more expensive and kind of flattens out, and that's what we're seeing now. If you look at the vol curve now, it's pretty flat across the board. Everything's kind of inflated fairly evenly, which is a little unusual, but so it's definitely not pointing. The vol curve at least is not pointing toward a continued bull market quickly. So just to go through some numbers on it so you can see it, this was a flash crash in 2010. So these are at the money implied volatility numbers. So if you look at the table here, this is the short-term option all the way out to the longer-term options. So what you'll see is as the crash happens, the short-term options inflate harder than the back-month options, right? So in this case, the flash crash brought the short-term up by 7 points, brought the long-term up by just 3. And then when the crush came afterwards, the short-term came down by 4 points, the back-month came down by 1 point. So the volatility sort of explosion and crush, if you will, is much more pronounced in the front part of the curve. In the crash of that sort of mini crash in August of 2015, same thing, you had a 40-point inflation in the front part of the curve compared to just 11 points in the back part. And then it crushed by 20 points on the front part and just 5 in the back part. So again, you're seeing much more dramatic numbers in the front part. In the recent sort of, I call it the XIV crash, but I don't know what history will call it, but you had a 60-point inflation in the front part and just a 10-point inflation in the back part, and a 50-point crush compared to a 7-point crush. So you can see the front part of the shorter dated options basically are blowing up and deflating, much more explosively and much more rapidly than the back part of the curve. I think for now, so for this presentation, the one I did on S&B, we went into like second order Greeks and stuff. I think for now it may be more useful to everyone to sort of show kind of how to use this and kind of what I'm doing to hedge in this fall environment, if that's okay. So I'm going to skip the second order Greek stuff. I'll send you guys the PDF for this, so if anyone wants it, you can certainly take a look at it. So yeah, let's go into maybe more kind of practical use of this. So I'm going to go back to Fixed Central, but I keep closing for some reason. Keep thinking I'm done with it. So basically, one of the things that I have been doing at Tactical Spreads that our customers are doing, we designed a hedge that takes advantage of sort of the expensive and the cheap part of the curve to try and get some long volatility exposure without paying for it. So typically when you are in kind of a normal market, go back to the historical prices. When you're in a normal volatility market, again, you have a curve that looks something like this. So if you are always buying volatility, if you buy volatility and hold it for 30 days, you can think of it as you're buying something at 12.53, and then 30 days later it's worth 11.78. So you're basically always losing money. So you're kind of riding this curve down if you're long vol. If you're selling volatility, you're making money because it's just decaying all the way down. So the idea behind the hedge that we were doing with volatility kind of in backwardation, we were essentially selling option premium, in this part of the curve and using that premium to buy long options in this part of the curve kind of perpetually. So that when we did get this move, here, oops, whoa, I don't want to zoom in. Let's reset that. So we were still, again, we were short spreads back here and long options over here. So when we got this move, when this happened, and we went from this environment to this environment, our spreads really didn't, they took a pretty good beating, but all the puts that we had up here, it's just exploded in value. So the hedge wound up paying out tremendously because of the way we have it set up. Now in the current vol environment, we can't really do that because we have really pricey options in the front month and, really not cheap options in the back month. So what we're looking at in today's vol environment, you've got to try to find a way to kind of exploit this and do some hedging that makes sense. So what I've been doing, and we've been talking about it over in the Slack group, let me pull over a risk graph. Hold on just a moment. Should have had this ready to go. Sorry about that. I'm just going to kind of go through an actual example here. All right, so okay. So I think this will be a pretty good example. Actually, maybe let me use the other one. Okay, great. That's perfect. All right, so I'm going to go back to. I think I put this on Thursday. I'll go back to Friday. All right, so what I've been doing is buying verticals and selling very short-term premium against it. So if we go back to Big Central, I'm basically buying verticals out here where the curve is relatively cheap and just selling garbage puts against it. Because these garbage puts that are 4 days from expiration, 5 days from expiration, because they're so inflated relatively speaking, we can get away with doing this. So if we were going to set up a trade, we could do something like going out to 90 days or so, even 120 days, 150 days, basically going out to these expirations that are fairly far dated and buying some put verticals. Right, so something like this, you can pay $6 grand, get 44 grand of protection, which is in and of itself very nice in terms of risk reward. and we're about a standard deviation away. But if you don't want to, pay the premium, you can put this trade on, and then you've just got to cover your $26 a day in theta. So the idea is we go into the front part of the curve where we know all the volatility is inflated. We go out maybe say 7 days or so, and you can sell, puts that are more than 2 standard deviations away for, a pretty decent premium. So for example, in this case, I would love for my hedge to go to 25.50 in the next, 7 days. I know I'm going to make, $6.5 or so. So I'm quite happy to sell, a small handful of puts over there, knowing that if we get there 7 days from now, I'm going to make quite a nice bit of money. Now this, if we sold 5 of them, that puts the delta pretty neutral, so that may be a little aggressive. So maybe you only sell 3 of them or 2 of them. But the idea is to at least cover your theta costs. So cover the cost of your hedge so that you're not having to pay your $26 a day to hold it. You could even do something like just selling 1 of them. Again, the puts are so expensive here that you're getting paid, $45 a day to hold your hedge instead of paying for it. Does that make sense? So doing something like that. And then in this case, you might want to set yourself up a trigger. So if we run up to, say 27, 20 or something, just give yourself some level where you're going to roll the whole structure up or roll the shorts up or add more shorts. You have to have a management plan to kind of deal with whatever it is. But this can give you a way to get, to have some bearish protection, get paid for it using the hyperinflated kind of front month. I call them garbage puts because we're at 2,700. This is 150 points away, a week out, with a weekend in between. If we roll the tape forward, we moved up a little bit, so you may want to roll the structure up, but that's lost 75% of its value already. Your hedge is down, but hopefully you've got bullish positions or at least some other position to kind of offset this. But in this vol environment, it's a good way to sort of cover your cost of hedging. So if you want to put some verticals on and sell some kind of garbage puts against it, if you are in a Reg T account, the way you would kind of replicate this so that you don't have to sell naked, you could just set this whole thing up as a calendar spread. It's not quite as effective, but you could go in and sell some of these puts and buy some of, maybe some of these puts. So you do the whole thing as a calendar spread, and you're not gonna get hit selling naked that way.
I got a quick question for you.
Sure.
So you're basically doing the opposite strategy of what you were doing back in January, correct?
Yes, that's exactly right.
So that means that your risk now is if the market tanks, you're going to lose a lot of money on your front month options, right?
That is correct. Now it has to tank all the way through. I mean, in this case, it would have to tank 150 points in 7 days. But yeah, it's totally, it is risky. Now, I guess the other side of the coin is that vol's already pretty inflated. So when you're looking at something like this, it is certainly a risk. But if we do get an event, we're already kind of inflated in the front month. So I shouldn't sugarcoat it. That is absolutely a risk.
But then you'd probably continue if the market continues to look like this, you would continue to just roll your short-dated options forward 7 days, right?
Yeah, and I've done this. Roll forward to the live position. I've managed to sell enough. Once I sell enough garbage to cover the hedge that I bought in the first place, I'm done. So sorry, no, not you. No, you also.
So you would maintain that exposure as long as the market stays the same.
Yeah, I don't mind holding. Let's see what's going on. I don't mind holding that position, so I think I took some of my shorts off today. Sorry, I kind of find all my. I had it on yesterday. Like, yeah, I mean, I had this on yesterday and kind of took some of it off. But yeah, I mean, essentially, if we stay in this kind of flat vol backward market where the vols kicked up here like this, I'm going to just try and sell a little bit. I'm not going to go crazy selling front month puts. I mean, I don't want to own more than, I don't want to say own. I don't want to be short more than a handful of those short puts.
Got it. And then the other risk would be if the market, say there's some big announcement and the market just goes up and is really strong over the next few weeks and goes back into a normal condition, contango-based curve, then you would lose money on the back month, correct?
Yeah, now the back months are spread, so they'll inherently lose a little bit less than if it was just a naked long. But what I have done, I mean, we've had a couple pretty strong up moves. I know during where was it? I guess just the last few days, I rolled some of the verticals up and just rolled the shorts, but just sort of rolled the whole structure up. Usually the front month premium is getting hammered so hard that as the market's moving up, you're not getting beat up too much. And in addition to that, I mean, it's a hedge, so my overall portfolio is short vol anyway, so I'm making money as the market goes up and the vol's coming up also.
So it seems to me that it's kind of like a trend following system, but you're following the trend of Vega. And so I guess what I'm wondering is, how do you know when to transition from one to the other?
I mean, I would just do it based on the vol curve. So if we go back into contango, I'm going to go back into just selling my back month spreads, buying the shorter dated longs. If we continue like this, I'm going to keep selling the garbage front month stuff.
Okay.
I don't know if that may not be a very satisfying answer.
Well, yeah, so you're saying it's basically kind of based on the shape and the feel and your experience. That's a good answer. That's fine.
Okay. Yeah, I mean, I always hate to kind of give the answer, well, you get a feel for it, but you do, I can look at this and say, like, okay, well, we're at 19 all the way out here, we're at 20 here, this is basically just a flat line. It looks all curvy and goofy, but it's pretty flat, so, this is telling me that we're not in a normal vol environment, that I can get away with selling front month stuff, and that it's totally fine to buy spreads back here. So yeah. I mean, I guess I'm not. I'd be a little miffed if that was my answer. But yeah, it is sort of a volatility. I guess you could think of it as a volatility trend following hedging system. And I'm really not trying to make a ton of money off this. I'm just trying to hedge my other short vol exposure. So basically, like, this is a hedge for my short vol, and then selling the puts against this is a hedge against the hedge. So I'm sort of hedging the hedge that is hedging my other hedge. Does that make sense? Is that helpful?
Yeah, it does. Great. Thank you.
Sure. Let's see. I feel like I wanted to go over one more thing. What was it? Oh yeah, I guess the other I wanted to also mention this. I have equity positions open too, and I'll often sell premium against those equity positions to hedge the stuff as well. So. For example, I have a position on Intuitive Surgical, and see if I can get rid of that other expiration. So the main position basically looks like this if we sort of look at the whole thing here. So I would love nothing more than this underlying to pull back, 15% over the next 5 days, right? So I'm perfectly happy selling what, in my opinion, are completely inflated puts down here to help cover some of the cost of the SPX, like those SPX verticals. So I'll hedge in other directions where I want the market to go. So, again, if Intuitive Surgical winds up at 360 a week from now, I'll be a happy camper. So I'm happy to go in here and sell, some 370, 360 puts a week out and just help defray some of that cost also. And these would just be naked puts. So that doesn't really make a lot of sense in a reg account. You have to do some spreads or something. So So that's kind of what I've been doing in terms of hedging in this environment, just because it is flatter on the curve and there's a lot of juice in the very, very low probability options on SPX. So if you go out and take a look at the SPX chain, if you just look at implied vol, we know that VIX has been hovering between 20 and 25, but if you look at these puts that are 4 days out and go down, down 25, 30, 2,500, the vol's up 27, 25, so, it's fairly juicy especially for 4 days away, so. It did come out a lot today. I suspect, though, with this move, we'll probably see some of it come back in tomorrow. So I think that's probably the meat of the presentation. I do want to kind of stop and let some folks ask questions if anyone has other questions.
Okay, does anyone have any questions here?
It almost sounds like in a short-term position, it almost makes sense to be short.
I just want to jump in here. I can't quite hear, so you may have to paraphrase this one.
I'll paraphrase it as soon as I get it out.
Okay.
It almost sounds like on a short-term basis, it makes sense to have like a short butterfly in the front month on volatility, on the VIX or the VXX, and at the same time have far out month the long butterfly.
So he's saying it makes sense to be short a butterfly in the front month and long a butterfly out in a more distant month? Is that what you're... With VIX being the underlying, does that make sense?
Short VIX flies in the front month and long VIX flies in the back month?
Correct.
Yeah, let's see. Let me think about that for a second.
In backward
The
days.
only problem with
Backwardation.
so the only problem with doing this kind of stuff on the VIX, and this is something that I should have mentioned earlier. That's a really good point. So when you talk about VIX, so the VIX options are tied to the VIX futures, and the VIX futures are a 30-day look, a 30-day implied vol on SPX. So I guess where I'm getting at here is that when you trade a 30-day VIX position, you're actually trading like a 60-day SPX position. So you can't really do a really short-term. If you do a really short-term VIX fly, it's still like a 35, 36-day SPX position. Because like a 0-day, a VIX expiration position is a 30-day SPX position because of what the VIX future is. Does that make sense? Like if you're holding a long VIX contract, it's a 30-day SPX implied volatility contract.
Right. Right. Makes sense.
So you can't really do, like you can't take advantage of where SPX is in terms of the implied vol. You can't take advantage of how juicy a 4-day SPX vol is using VIX because VIX doesn't have a 4-day SPX vol. The closest thing VIX has at expiration is a 30-day position. If you look at the same contracts that are at like 20 vol, you can go down here and do like some 25. But, you could do short butterflies against long butterflies. Trying to think if I see any reason not to do that. It's a lot of contracts. That would be my only initial thought there is that it'd be a lot of contracts. But yeah, you could certainly, I mean, selling anything here and buying something here is the way to kind of try to take advantage of this. The more direct way to do it, especially if you're with like a futures broker that allows this, is, it's certainly riskier, but if you think you're going to get reversion to the mean here, you can just short this month and buy this month, just a VIX calendar. If you want to do it less risky, you can short this, buy 2 of this, and short this. which kind of gives you sort of a similar exposure. But it's a little dicier. In general, though, being short 1 month and long the next month is a pretty solid trade. When you're talking VIX futures, that's more of just a VIX futures trade rather than options trade. But it's super risky doing the front month in case you go from contango to backwardation. But historically, if we're in backwardation, shorting the front month and going long the back month has been a pretty high probability play. We don't usually stay in backwardation very long. This has kind of been an unusual situation, and we've been backward for quite some time now. So. But I guess, yeah, a good takeaway, if anyone doesn't know this already, is that when you're talking the 12-day VIX option, it's not a 12-day SPX option. It's a 42-day SPX option, basically. So make sure if you're doing any kind of comparison between the two, you're doing apples to apples.
Matt, could I ask a question?
Yes, sir.
Have you concluded that VIX is pretty useless? In other words, one of the lessons I'm getting from your presentation is that, and from what you've said elsewhere, is that you can get anything you can get from the VIX, you can pretty well get from, at least in terms of buying your own position, you can get from other instruments that you can get closer in.
Oh yeah, I mean, like VIX is nothing but an SPX proxy anyway. So in terms of like using VIX to hedge, I wouldn't do it. I mean, I actually looked at shorting VIX to go long SPX just because you get more explosion out of SPX, and it was actually a pretty decent trade. I wouldn't call it useless, but again, that just a straight futures trade of being short 1 month, long the next month is usually a pretty solid trade. But taking it close to expiration is pretty risky.
Are there any advantages to trading the VIX over just trading the SPX or ES options? Because you can get it much closer when you need to with the ES or the other stock index options.
Yeah, none that I've found. I mean, I'm sure there's plenty of people that argue the other side of that question, but I have not found any advantages to using VIX over SPX.
Yeah, exactly.
I mean, it's a basket of options. I guess maybe that's one advantage. So you're not, it's almost like trading the average implied volatility rather than a specific strike implied volatility. But if you have a prediction that vol's going up, you might as well buy the strike that you think it's going to go up more on, rather than just buying the average. But so the short answer is no. I don't think there's really any advantages. But I'm sure there's probably many people that are probably smarter than me that would argue the other side.
I got another question. So it seems like you do this more of like an income-based strategy, but you also mentioned that you are hedging a larger portfolio to a degree. How do you determine how much you should hedge? Like in other words,
so that's a very good question. It's one you better get right too. I had the misfortune of getting it wrong in one of my portfolios in February. It took a massive beating, but basically, whatever you're trading, look at how much it's going to get hurt in an event like February 2018 is a very good recent event we have to look at, and basically structure your hedge such that it's going to make that up and then a lot more. With this specific kind of hedge where you're long really front month puts, if you don't get the exit timed right, you're going to miss like half the profits or more. So you have to make sure you structure your hedge such that it's going to provide enough profit and a large enough window for exit against whatever whatever else you're trading. But yeah, I really don't use the hedge as an income generator. I just use it as a hedge. So most of my trading is short vol, neutral delta kind of trading. So it's just hedging. It's basically hedging volatility risk for the most part.
Matt, we're running low on time. You should tell us a little bit about any services that that may be of interest to our members.
Thank you.
Yeah, go ahead.
Thanks for. So yeah, I'll go back to the slides here. So I did set up a coupon code for you guys. If anyone wants to take advantage of any of the courses that we do. So we have the hedge strategy that I kind of talked about. I call it the Kennedy hedge. It's sort of the contango-based hedge. And I'll send you guys the slides too. If you do want to purchase that course or any of the other courses on the site, I'm going to throw in a free 30-minute one-on-one coaching session if you use the promo code Raleigh18. I hope I spelled Raleigh correctly. I didn't look it up. I think it's an EI. We have other trades also. There's a Skyline trade that's more of an income trade that can be used as sort of a convertible hedge trade or an income trade. I'm using it as an income trade these days. Also have a class on the another programming butterfly that I call the fruit fly trade. So we have that on the site as well. That coupon code is good for any of those courses. So anything you would like to make a purchase on, just plug that code in, and it will it'll basically just generate a record for me so that I know to set you up with that free coaching session. And last but not least, as I mentioned before, I do run an asset management service. So if you are interested in having the firm trade those strategies, if you want to do this kind of thing but don't want to devote time, energy, effort, if you or family members want to take advantage of it, just drop me a line and I will send you more info and we can chat about that at the address there. It's in Williamson, which is short for Matt, obviously, in Williamson at Williamson Financial.
And can you recap the main offer again?
Yeah, it's just a free 30-minute coaching session with any course that you decide to purchase. So we've got a number of courses on the site that that are available for purchase. Just plug in the promo code at the checkout, and we'll do a free 30-minute one-on-one session.
And that includes the Kennedy hedge?
Correct, yeah.
How much is the Kennedy hedge?
It is $299.
So
and all the courses, yeah, try to price it affordably. All the classes also come with private chat access, so anybody else that's bought the course is going to be in a private chat room that you have access to for life. So no ongoing cost there.
And the Kennedy hedge is the basis of the strategy that you developed that is being used by the SMB.
Correct. Yeah, we're still kind of trying to work out all the details of how to get me on board doing the whole, managing the hedge for the firm. But yeah,
which is a big endorsement for them to get that for their trading desk. Means that
they had a trader on the desk that had the position on during the February event. It did well for anybody that had it on. But yeah, they saw how well it did, and Seth reached out to me and started talking about stuff. So.
And because they evaluated that very carefully, and yours was one of the only ones that actually worked in the first crash.
Yeah, it works well on a big event. I mean, it does. It certainly has its weak point. If we're kind of grinding lower, it's not going to do a whole lot just because those front month puts don't get bid up. But in a real volatility event, it does great. So
tremendous. We better get out of here just because the library gets anxious if because they're trying to close the doors.
Okay, gotcha.
Let's have a really nice hand for Matt.
Thanks, guys.
Thank you
for having
very
me, gentlemen.